Hi, good morning. Let's today discuss about variance analysis. Variance analysis. Um, in a standard costing, we set standards for costs. Also, we set standards for revenues. We use these standards in the budget preparation and estimate the future costs for a given level of activity. Given level of activity means how many units we are going to produce and sell. At a certain capacity level, say 10,000 units, what is the total cost? What will be the total revenue? And what will be the profit? We budget it well in advance. And when that period comes, how many units you produced, how many units we sold, and what is the profit? When the actual profit is different from the budgeted profit, we see the difference. If the difference is insignificant, not much, the difference is not much, ignorable, we be silent. But if the difference is significant, management by exception will exist and investigates the reasons for the difference in the profits. There you will find the differences in costs, the differences in revenues, due to which the difference is there in the profits. Management by exception investigates the reasons for the variances and finds the department managers responsible for that so that we can have a control over the costs, control over the revenues. So for that reason, first of all, we need to know what should be the cost at a given activity level. When we find the cost at a given activity level, it will become base to compare with the actuals. Therefore, we should well in advance estimate the total cost and revenue and the profit as well at a given activity level by preparing a budget called static budget. Static budget is a budget prepared at one level of activity, one level or constant level of activity, constant level of activity. Here level of activity level means the number of units that can be manufactured and sold, the number of units that can be manufactured and sold, and the cost and revenues are estimated at that level. Okay, it is the base for setting the standards to compare with actual amounts of costs and revenues. So static budget is used as a base for setting the standards to compare with the actual amount of costs and revenues. Now let us prepare a static budget for a given level of activity. Say for example, here this is the static budget. We are preparing for 10,000 units. 10,000 units. So if I produce and sell 10,000 units, what would be the profit? Say for example, direct material. Direct material is say $100,000. $100,000. Direct labor, say $80,000. Okay, then fixed overheads, say $120,000. Yeah, variable overheads, say $30,000. So here the total cost will be 330,000. If all these units are sold, at the rate of, say for example, all the 10,000 units are sold at the rate of say $72, it should be 720,000. Sales should be 720,000. So when sales are 720,000 and estimated profit would be profit would be 72,000 minus 330,000. So we are estimating a profit of 390,000 at a capacity level of, at an activity level of how much? 10,000 units. These 10,000 units, can be 10,000 units or more than 10,000 units in actual. Can be 10,000 or more than 10,000 or less than 10,000, because this is prepared well in advance for the next year. Say for example, this budget was prepared in the year 2015. 2016 year end will come to know that how many units are prepared and produced and sold. Say for example, 12,500 units, actual units are produced and sold due to heavy demand. So obviously the material cost, labor cost will go up because this budget was prepared for 10,000 units, but the actual production was 12,500. So these are all variable costs. So obviously will change. Variable overheads will also change. Fixed overheads may or may not change. Therefore, there will be change in the profit. So if I have an amount of, say for example, $120,000 here, say for example, these amounts are for 12,500 presented like this. These are all presented like this. This is 120,000. Okay. And here 120,000. This is 92,000. Okay, this is 120,000 same. Here it is, say for example, variable overheads, it is 32,000. Okay, now we see here this amount should have been how much? 120,000 or 12,500 units. 12,500 units times, say for example, it should have been 72, but we sold it for 70. So it's a kind of misunderstanding that how, when a budget is prepared for 10,000, the profit estimated is 390, and when the sales are 12,500 here, sales are 12,500 but sold at the rate of 70. Yeah, the sales are 12,500, 12,500 units at the rate of 70. We sold at less price. There are so many reasons for the difference in profit here, and profit is, the difference is significant. Okay, why? Because it's not a small amount. So obviously we need to investigate this. First thing is that we sold 12,500. We should be very happy that our capacity level increased from 10,000 to 12,500. So obviously the profit should be more. This is actuals. So the profit should be more when you sell 2,500 units. What is the reason why the profit is less as compared to last year at a budgeted amount of 10,000 units? So you need to investigate. Here 10,000, 100,000 is the direct material cost. Here it is 120,000. So you cannot say that why did you spend $20,000 more? The purchase manager and production manager may claim that, see, this budget was prepared for how many units? The budget was prepared for how many units? 10,000 units, but actual production was 12,500. So you cannot compare the cost of 10,000 units with the cost of 12,500 units. Likewise, direct labor. Likewise, fixed overhead. Fixed overhead is okay. Fixed overhead will be constant. Likewise, variable overheads. Variable overheads, it should be 32,000, right? Okay. There was a profit. There is a profit of 511,000. In fact, 390, 511,000. There is no loss here. But still, why this 120,000? Why not 100,000? You know, can be like that. Or we sold it for say 68, not so it is 486,000. The 12,500 units are sold at the rate of 68. So the sales department will be investigated. But why they sold it for 68? Say for example, this is 45,000. So for 73,000. This is say for example 108,000. So it is 457,000. Just only 60,000 profit, 67,000 profit more here, or we'll take it like 132,000 here. I'm just changing the amounts to show you that only 55,000 is a profit here. So when 2,500 units sold extra, we are expecting more profit, and here only 445,000. Still, you need to investigate what are the reasons why the difference took place. That is the reason why you need to prepare a static budget or a flexible budget. Why? Because you cannot compare the cost of 10,000 units with the 12,500 units. We cannot justify that unless otherwise you need to have an adjusted figures here. Okay, flexible budget is an adjusted budget based on the actual results considering the information from static budget. Okay, so flexible budget only is used for the variance analysis. Why? Because the amount is different, the volume is different. Okay, when the production volume difference takes place, we should use the flexible budget to compare with the actuals and analyze the variances. Okay, so flexible budget is a must. So let us see here how the flexible budget takes place. So let us develop a flexible budget using the static budget. This is a flexible static budget. Yeah, this is a static budget, this is the actual result. So let us move here. Yeah, so you have a sale of this much, and let us have the fixed flexible budget. And this is actual results. I'll just move this here. Okay. Yeah, fine. So now here material cost for one unit will be $100,000 divided by 10,000 units. That is $10. $10. Likewise, this divided by 10,000. 80,000 divided by 10,000. $8. This will remain same. Likewise here, $30,000 divided by 10,000 units. So let us calculate each, this will be, yeah, $3. So when you prepare a flexible budget, remember always you take the quantity from actual results, but the information from static budget. See, it's an adjusted budget based on the actual results, considering the information from static budget. Okay, so cost and revenue information. So 12,500 units, the direct material should have been 12,500 times this much. It should have been 125,000. We spent how much? 132,000. So there is a variance. Never compare here again. Only flexible budget figures are to be compared. And here it is 12,500 times $8. It should have been 100,000. Okay, right. It should have been 100,000. We spent 108,000. Say for example, fixed overhead we spent same amount. It should be same, no? Irrespective of the activity level, it should be same. Then it should have been 12,500 variable overheads times $3. 37,500. You spent almost all the variable costs have gone up. Okay. Now, say for example here sales. How much sales should have been? Sales you are selling at the rate, at the rate of 70. You should sell at the rate of 72. So 12,500 should be sold at the rate of 72. 72. So 12,500 times 72. 900,000 should be the, and what is the cost here? Cost should have been, total cost should have been this much, 1,507,000. This much? No, this is 125 times H28. 12,500. No, yeah, 12,382,500. So the profit should have been, yes, 517,500. Why 445,000? Listen carefully once again. When you are finding any difference between the actual activity level and the static budget, when we find any difference between these two, you should develop another budget called flexible budget. Once you develop the flexible budget using the quantity from actual results and the information from static budget, you just block it. You don't need this. You don't need this. Only you need to compare like this. So you will have a variance analysis here. Okay, that reconciliation we will do it now. Okay, so what is the difference in profit? Difference in profit between only flexible budget and the actual results. Flexible budget. How much? 517,500. Okay, and actual 445,000. Okay, difference, that is variance. I'll write variance. Variance of this much. This much profit you got less. This much profit you received less. Means when a profit is received less, it is called unfavorable variance or adverse variance. Okay, unfavorable variance. Then what are the reasons for this $75,000 profit difference? So in the case of direct material, how much it's supposed to be? 125,000. How much is this? 132,000. So the cost should have been 125, but the actual cost is 132. It is unfavorable. So you can write UF or adverse. You can write a letter A. Then direct labor. How much the cost should have been? 100,000. What is the actual cost? 108. So unfavorable. Unfavorable variance of 8,000. These unfavorable variances are the reasons for the difference in these profits. So far you found a difference of 7,000 and 8,000 in direct material and direct labor because you spent more here. Okay. Now fixed overheads 120, 120. Let us assume that the amount is maintained same 120 as in the case of fixed static budget. So there is no variance here. Nothing. Zero. Now, coming to variable overheads, 37,500 supposed to be the amount, and now what you spent was 45,000. So 7,500 again unfavorable. Okay, unfavorable variance of 7,500. Now, not only in the cost, you have a variance also in the revenues. In the revenues, there is a variance of what revenue you should have maintained, 900,000. You should think in a reverse mode. How much revenue you received? 850. How much revenue you should have received? 900. So 50,000 unfavorable. So if you take all these unfavorable variances total, okay, 7,000 unfavorable, okay, 8,000 unfavorable or adverse, 7,500, okay, unfavorable, then 50,000 unfavorable. The total will give you the reasons for this. 72,500 unfavorable. So this is a RICO for um, the difference in profit, so that we can take action on material like production department, purchase department, etc. Labor, HR department, production department, etc. Okay, so we cannot blame just the sales department for all 72,500 or the production department for all 72,500. We have the variances in respective departments here, so you'll have to take action in those departments for those amounts. Let me write a RICO here, reconciliation. Yes, so you should have this. Then you will check $7,000 why there is a difference in material, whether material purchased at higher price or material used in the production higher quantities than the prescribed. Okay, so when we discuss about these three budgets, we have static budget, we have flexible budget. Flexible budget will only be there when there is a quantity difference, and we have actual results. Actual results. Okay, when you compare static budget results with actual results, which is of no use if there is a difference in the quantity, which is not useful at all in the analysis. If there is an activity difference, such a variance is called as static budget variance. If you compare the static budget with the flexible budget results, it is called as sales volume variance. You can only just think that why we budgeted 10,000, what made us to sell 12,500. In fact, it's a good sign, but sometimes you might have budgeted at 10,000, you might have sold at 8,500. It can be like that. So what is the reason for sales volume variance, we can check. And when you see the flexible budget, when you compare the flexible budget results with the actual results, this is called flexible budget variance, and this is what our topic is: flexible budget variances. This is our topic. This is what we are going to study. We are going to study the flexible budget variances in our topic, studying the reasons for these variances. Okay, this is about static budget and flexible budget. So now, once we know the flexible budget, uh, let us discuss about the different types of variances and how they take place in the books and how to identify them. Variance. Variance means variance is the difference between the predetermined amount and actual amount. So predetermined amount can be cost, then actual cost will be compared. Predetermined amount can be revenue, then actual revenue will be compared. So here variance can be a favorable variance or unfavorable variance. Okay, favorable variance means what? Favorable variance in which you will have the actual cost will be less than the standard cost. The actual cost is less than standard cost. Okay, say for example, actual cost what you incurred is less than standard cost what we predetermined. Okay, and is denoted by it is denoted by letter F, favorable. So actual cost is less than the standard cost. We estimated that the cost can be $10,000, but we spent only $9,500. So there will be a favorable variance of $500. Example, budgeted standard cost was for $10,000, but at the same activity level, the actual cost incurred was $9,500. So what is the actual cost here? $9,500. But how much you budgeted? Okay, $10,000. Okay, so standard cost is $10,000 and actual cost is so variance is $500 favorable. Okay, if it is the other way, it will be unfavorable variance. Okay, say unfavorable variance. The actual cost incurred is more than the standard cost set. Okay, so here actual cost is greater than the standard cost. So for example, the budgeted cost of an activity level is, say for example, 10,000, and actual cost incurred for the same activity level was, say for example, 10,300. So what is the actual cost here? 10,300. 10,300, and the standard cost was 10,000. There is a variance. The variance is $300 unfavorable. Unfavorable, okay, and it is denoted by letter A. A means adverse. Adverse or unfavorable. Unfavorable means UF. Okay, yeah. So this is in the case of cost. In the case of revenues, it is the other way. Okay, favorable variance takes place. Favorable variance takes place if the actual revenue is greater than the standard revenue, and unfavorable variance takes place if the actual revenue is less than the budgeted revenue. Okay, so it is the other way. Let me add a sentence here. Yeah, otherwise I will use this again. Favorable variance for revenues. These are all costs. Yeah, these are all for costs. Costs. Likewise, if it is a revenue, then the scenario is different. This is for revenues. For revenues, the favorable variance, actual revenue is greater than, higher than standard revenue. Is standard revenue or budgeted revenue. So here actual revenues should be greater. Please think in the other way. Okay, it should not be less, it should be greater. Actual revenue should be greater than the standard revenues or budgeted revenues. Say for example, budgeted revenue was 10,000, and the same activity level, the actual revenue is 10,500. See, when it was 10,500 there, here it was unfavorable, 10,300. But in the case of revenues, revenue should be greater. So $10,500 we received against an amount of $10,000 expected. So there is a variance of $500, but which is favorable. Why? Because our actual revenues are greater than the budgeted revenues. Likewise, you may have unfavorable variance also. Okay, so in the case of unfavorable variance, it is the other way. Unfavorable variance. The actual revenue is less than the standard revenue. It is denoted by letter A. A means adverse or unfavorable. So actual revenue is less than standard revenue. Budgeted revenue is 10,000, and the actual revenue for the same activity level was say 9,300. So we expected a sale of 10,000, but we sold only 9,300. So $700 is the variance, which is unfavorable. Unfavorable. Okay. So in the case of revenues, the actual should be higher, whereas in the case of cost, the actual should be lower, because these are all our expenses, whereas these are all our revenues which will improve the profit if actuals are more. So in the case of revenues, please think the other way. In the costs, the actual should be less. We will study the variances here in this topic, beginning from material. Okay, so the list of variances we are going to study include direct material variances, direct labor variances, okay, overhead variances, and sales variances. So we have four different types of variances. Okay, in direct material variance again, you have direct material, direct material, direct material price variance, and direct material quantity variance. Yeah, yeah. So these are direct material variances. Direct material variances are classified into direct material price variance, direct material quantity variance. Direct material quantity variance is further classified into direct material mix variance and direct material yield variance. So in the direct material variances, we are going to study total four variances: price variance, quantity variance, mix variance, and yield variance. Okay. Likewise, we will study direct labor variances. Direct labor variances, in which we are going to study direct labor rate variance. Material variance will become price variance will become rate variance. Just use DL or V, rate variance. And here direct labor, because you show efficiency. In the case of laborers, you show efficiency by completing the task in less number of hours than the provided number of hours. Say for example, I want my workers to complete this task in 25 hours. They completed in 20 hours. They are more efficient. They saved labor cost. So the next one is direct labor efficiency variance or direct labor usage variance. Direct labor usage variance is further classified into direct labor mix variance and direct labor yield variance. So in direct material variances, you have four variances, and direct labor variances, you have four variances total, direct eight variances. Then you have overhead variances. Overhead variances are further classified into fixed overhead variance. Yeah, let us take this picture. Overhead variances are further classified into fixed overhead variances, fixed overhead variances, and variable overhead variances. Variable overhead variances. Fixed overhead variances is further classified into two. One, fixed overhead variance is further classified into two. One, variable fixed overhead spending variance, fixed overhead spending variance, spending variance, and here the production volume variance. volume variance. Then variable overhead variance is further classified into, let me, yeah, variable overhead spending variance, and here variable overhead efficiency variance. Variable overhead spending variance, variable overhead efficiency variance. So you have here four variances. Do not count these. This is only just categorization, classification. So you have four variances: fixed overhead spending variance, production volume variance, variable overhead spending variance, and variable overhead efficiency variance. Okay. Then you have sales variances. Sales variances are further classified into the entire topic variances we are discussing now, but we'll discuss in details with the formulae and calculations. Only let us discuss names now. That's it, names only. Okay. Now sales variances. Sales variances are further classified into, yeah, sales variances, sales price variance, sales price variance, and sales quantity variance. Quantity variance. Then nothing here, nothing here. But you have one more variance called sales mix variance. Very important one, sales mix variance. So 3 here, 4 here, 7 plus 4, 11 plus 4, 15. So total 15 variances we are going to discuss here. 15 variances will comprise of our entire syllabus.